Did you know that choosing the right ETF could mean the difference between retiring comfortably or running out of money too soon? And here's the kicker. Most people overlook the subtle details that could cost them thousands over time. But don't worry, in this video we're breaking it all down for you. Today we're diving into two of the most talked about ETFs out there, QQQM and SCHD. One promises explosive growth driven by the tech giants shaping the future, while the other offers stability, reliable income, and long-term consistency. Which one is right for you? Well, it depends. But here's the deal. By the end of this video, you'll know exactly how these two ETFs stack up, what makes them unique, and most importantly, how to choose the one that aligns with your goals. So whether you're planning for retirement, building generational wealth, or just getting started with investing, this breakdown is tailored for you. Stick with me to the end, because the insights you're about to hear could completely transform the way you invest. Let's start by breaking down what these two ETFs truly represent. First, QQQM. Think of it as the younger version of the iconic QQQ. It highlights the Nasdaq-100, featuring some of the most prominent tech giants. Imagine names like Apple, Nvidia, and Amazon. Trailblazers shaping the world through cutting-edge advancements. This ETF focuses on expansion and seizing high-growth opportunities in the tech sector. Now, SCHD takes a completely different direction. It's tailored for dependability and steady earnings, emphasizing companies that consistently deliver dividends. Remarkable, isn't it? When you stretch the timeline to 10 years, QQQM's growth rate reaches 77.65%. That's a clear reflection of the transformative power of the tech sector. These companies are often at the forefront of innovation, pushing boundaries and creating entirely new markets. However, it's important to note that the ride isn't always smooth. Tech stocks are known for their volatility, while they can deliver incredible gains. They're also prone to sharp declines during market downturns or economic uncertainty. This makes QQQM appealing for those seeking growth, but it requires a willingness to weather the inevitable ups and downs. Now, let's shift gears to SCHD, which takes a more dependable and predictable approach. Over the last year, SCHD's provided a respectable return of 17.96%. It may not seem as dramatic as QQQM's performance, but SCHD's strength lies in its consistency. It focuses on companies with a proven track record of paying dividends, ensuring investors receive steady income alongside capital appreciation. Over a decade, SCHD has outpaced QQQM with a remarkable return of 114.28%. This highlights the benefit of a long-term strategy centered around stability. What's more, SCHD often appeals to those looking for less risk and more reliability, particularly during economic uncertainty when dividend-paying companies tend to hold their ground better. Adding to its appeal, SCHD features some of the most reputable names across industries, like Coca-Cola, PepsiCo, and Home Depot, firms that deliver both resilience and returns over time. It's a solid choice for investors prioritizing dependable growth with a side of income. In summary, while QQQM offers the thrill of tech-powered expansion, SCHD provides a calmer, more predictable journey, making it ideal for those focused on balancing risk and reward. So, what does this actually mean? If you invest $100,000 in SCHD, you're earning approximately $3,390 every year in dividend payments, before even considering reinvestment. That's a substantial passive income stream, making SCHD highly attractive for income-focused investors. But here's where it gets even better. SCHD's dividends are not static. They've grown at an average annual rate of 11.13% over the last decade. This is the power of dividend growth combined with compounding. As the payouts increase and you reinvest those earnings, your returns grow exponentially, creating a snowball effect that can significantly enhance the value of your portfolio over time. For example, reinvesting those dividends over several years can lead to remarkable growth, even during market downturns. Dividend-paying companies tend to be resilient, and their reinvested payouts can add extra shares to your portfolio, boosting both income and total value. Now let's talk about QQQM. It's in a completely different category when it comes to dividends. With a much smaller yield of 0.63%, a $100,000 investment in QQQM would bring in just $630 annually in dividends. Clearly, this isn't going to generate life-changing income, but that's not QQQM's purpose. QQQM is all about capital appreciation, driven by the growth of tech giants and innovative disruptors, instead of providing high payouts. It reinvests its gains back into capturing market growth for investors looking to build wealth primarily through stock price increases. This ETF is geared toward long-term capital gains rather than consistent cash flow. Looking deeper, this contrast highlights the importance of aligning your investments with your financial goals. If you're building a retirement portfolio or seeking consistent income to support your lifestyle, SCHD's stable, growing dividends offer a compelling case. On the flip side, if you're in a growth phase and want exposure to the fast-paced world of tech and innovation, QQQM's potential for higher returns through appreciation might be more appealing. So, here's the takeaway. SCHD shines for those focused on stability, compounding income, and long-term security, while QQQM thrives in portfolios aiming for growth and market-leading innovation. Your decision ultimately depends on whether you value reliable cash flow or the potential for explosive gains in cutting-edge industries. We're looking at heavyweights like Apple, Nvidia, and Amazon, global leaders setting the pace for innovation. These companies dominate industries such as AI, cloud computing, and electric vehicles, reshaping the way we live and work. However, there's a downside to this concentration. QQQM's heavy reliance on tech means that if the sector experiences a downturn, the ETF can take a significant hit. It's a classic case of high risk paired with high potential reward. Investors betting on QQQM need to be prepared for volatility and understand that the same rapid growth fueling gains can lead to sharp declines during market corrections or economic uncertainty. On the other hand, SCHD offers a completely different approach. It's designed with diversification and stability in mind, spreading its focus across sectors like financials, healthcare, and consumer defensive industries. These are areas known for their reliability even during economic slowdowns. Unlike the tech-savvy QQQM, SCHD aims to balance growth with protection, reducing risk while still delivering solid returns. Some of SCHD's top holdings include major players like Cisco, a leader in networking and IT solutions, Home Depot, a retail giant in home improvement, and Pfizer, a powerhouse in pharmaceuticals. These companies represent sectors that tend to perform consistently, offering investors a mix of steady growth and dependable dividends. By balancing its portfolio across multiple industries, SCHD ensures it isn't overly reliant on a single sector. This makes it a solid choice for investors seeking a more conservative strategy that still offers opportunities for growth. In essence, QQQM thrives on the fast-moving, high-stakes world of tech innovation, while SCHD provides a steadier, more reliable path with a focus on resilience and income. It's a question of what matters most to your portfolio: exciting growth or dependable stability. Costs matter, and when you're investing, even small savings can add up significantly over time. SCHD takes the lead here with its impressively low expense ratio of just 0.06%. What does that mean? For every $10,000 you invest in SCHD, you're only paying $6 a year in fees, practically nothing compared to the potential returns. This makes SCHD one of the most cost-effective options on the market, especially for those focused on long-term wealth building. In comparison, QQQM has a slightly higher expense ratio of 0.15%. For the same $10,000 investment, you'd be paying $15 annually. While that's still relatively low in the world of ETFs, over time, those additional costs can add up, particularly for long-term investors aiming to maximize returns. Here's why this matters. Lower fees mean more of your hard-earned money stays invested instead of going towards expenses. Those savings can compound and grow alongside your portfolio. This compounding effect might seem small initially, but over 10 20, or even 30 years, it can translate into thousands of dollars in additional returns. For instance, if you're planning to hold for decades, SCHD's cost advantage becomes a noticeable benefit. Every dollar saved on fees is a dollar that continues working for you, generating income and capital growth. This efficiency makes SCHD especially appealing for investors looking to optimize long-term results without sacrificing performance. While QQQM's expense ratio remains competitive and reasonable, the small difference highlights the importance of evaluating fees, especially if you're building a portfolio for retirement or other long-term goals. In the end, SCHD's ultra-low cost gives it a subtle but meaningful edge for investors who value cost efficiency and steady compounding over time. QQQM is an excellent choice for those who have a long-term vision and can handle the inevitable ups and downs of the tech industry. It's particularly well suited for younger investors or anyone with time on their side. Why? Because this ETF thrives on the potential for significant growth over the years, fueled by leading-edge industries like AI, cloud computing, and renewable energy. While the current dividend payouts are modest, the focus here is on maximizing capital appreciation, growing your wealth through stock price gains rather than income generation. In contrast, SCHD is tailored for a more conservative investor profile. If your priority is stability and you appreciate the reliability of steady income, SCHD could be a better fit. This ETF shines for individuals closer to retirement or those who prefer a balanced approach to growing their portfolio. Its focus on dividend-paying companies provides consistent cash flow, making it ideal for anyone seeking predictable returns without sacrificing growth potential. With sectors like financials, healthcare, and consumer staples leading its allocations, SCHD is designed to weather economic fluctuations while delivering long-term value. One noteworthy aspect is the strength of SCHD's dividend growth. Over the past decade, its payouts have increased by an average of 11.13% annually, creating a powerful compounding effect when reinvested. For those nearing retirement or relying on their investments for supplemental income, this combination of steady returns and low volatility is invaluable. At the end of the day, it's not about which ETF is inherently superior, it's about which one aligns with your personal financial strategy. Are you aiming for aggressive growth and willing to embrace the risks associated with a concentrated sector like tech? Or do you value consistent income and a more predictable portfolio that can serve as a reliable foundation? Take some time to consider your financial objectives, your comfort level with risk, and the timeline you're working with. Whether you're saving for retirement, building wealth for future goals, or seeking a mix of growth and security, understanding your priorities will make the decision much clearer. And that's it for today's breakdown. If you found this helpful, be sure to like, share, and subscribe for more insights. Thanks for watching, and we'll see you in the next video. Here's to your investing success, profitable investing.